For what feels like ages, the one word on every economist's lips has been slowdown. But the U.S. economy, well, it seems to have missed that memo. It's actually hitting the gas. Today, we're going to unpack this surprising economic puzzle and figure out what it could mean for all of us in 2026. So that's the big question, isn't it? Recession or boom? The signals are completely mixed. All the experts were bracing for a cool down, but the actual data is screaming growth. It's a huge disconnect, and it's leaving a lot of people scratching their heads. And just take a look at this chart. It shows you just how massive that disconnect really is. The forecast, the long-term sustainable growth for the U.S. economy, is pegged at around 2%. But what actually happened? In the third quarter of 2025, the economy grew at an annualized rate of over 4.4%. That's more than double what anyone expected. Which brings us to the million-dollar question. Why is the economy running so incredibly hot? To figure this out, we can't just react to the daily headlines. We need a real framework, a map to guide us.
And the good news is the pros don't just guess. They use a powerful tool that helps them cut through all that noise. It's kind of like an economic map that lets them see the big picture.
And that tool is called the Merrill Lynch Investment Clock. Honestly, the best way to think about it is like an economic GPS. It's a framework that helps us pinpoint exactly where we are in the economic cycle and see the possible roads ahead.
So, what is it really? Well, the investment clock is this amazing model that links the big economic cycle with how different investments might actually perform. And it all boils down to just two key metrics: economic growth and inflation. That's it. Sounds simple, but wow, is it powerful. Okay, so this is the heart of the whole thing. The clock breaks the economy down into four distinct phases. First up is reflation. This is when both growth and inflation are falling, a great time for bonds. Then, as the economy starts to heal, growth picks up, but inflation is still low. That's recovery, the absolute sweet spot for stocks. But if things get a little too crazy, both growth and inflation start rising together. We call that overheat, and it's when commodities really shine. And finally, if growth stalls out but prices keep climbing, you get the dreaded stagflation. In that world, cash is king.
All right, now that we have our secret decoder ring, let's play detective. We're going to use the clock to diagnose exactly where the U.S. economy is sitting right now. All we need are our two clues.
Okay, clue number one, growth. And man, is it a big one. As we just saw, that third quarter GDP was absolutely blistering at 4.4%, way above the country's sustainable rate of around 2%. So we can definitely check the box for strong, rising growth.
And clue number two, inflation. You've probably heard the word sticky a lot lately, and that's exactly what it is. It's just hanging around that 3% mark. Now, it's down from the peak for sure, but it's still well above the Fed's 2% target, and there are risks that could push it even higher. So let's check the box for rising or at the very least elevated inflation.
So here's the moment of truth. You take those two pieces of the puzzle, that super strong growth and that stubborn rising inflation, and you put them on our investment clock, you land squarely in one quadrant: overheat.
And listen, this isn't just us spitballing here. This is what professional financial analysis is confirming. The data is pretty darn clear. The U.S. economy has officially entered the overheat phase of the cycle.
Okay, so we found ourselves on the map. We're in the overheat zone. But the big question now is, what's next? Where does the clock turn from here? Well, the analysis points to three main possibilities for 2026.
Let's talk odds. The most likely path, sitting at a 45% probability, is what they call a soft landing. But look how close behind that is. At 35%, you've got the risk of stagflation. And then there's a 20% chance of a hard landing, which is just another name for a sharp recession.
So what do these actually mean? A soft landing is the dream scenario, right? Growth cools down to a more normal level, and inflation just kind of fades away. Stagflation is the one that really hurts. The economy slows down, but prices keep going up, maybe because of things like new trade tariffs or supply chain problems. And finally, a hard landing. That's the recession everyone was so worried about a year ago, where high interest rates finally take their toll.
So how on earth do you invest in a situation like this? You've got this hot, booming economy right now, but this really nasty risk of stagflation lurking around the corner. Well, this kind of uncertainty calls for a very specific and pretty clever investment strategy. That strategy is called the barbell. And the idea is actually pretty genius. Imagine a barbell at the gym, right? You've got heavy weights on both ends and nothing in the middle. That's what you do with your portfolio. You hold assets that do great in the current overheat, and at the same time you hold other assets that will protect you if we slip into stagflation. You're prepared for both extremes.
And here's exactly what that looks like. On one side of your barbell, you've got your growth assets. For this overheat phase, we're talking tech, AI, industrials, things that do really well when the economy is firing on all cylinders. Then, on the other end, you have your defensive assets to protect against that stagflation risk. Think consumer staples and healthcare, companies that sell things people need no matter how the economy is doing.
So, let's get into the nitty-gritty. What's the playbook here? The strategy suggests being overweight equities, but focusing on companies that have what's called pricing power, meaning they can raise prices and customers will still buy. It also means being overweight commodities, which is a classic move to hedge against inflation. Meanwhile, you'd be a little more cautious on bonds, maybe neutral to underweight, and you'd keep a decent amount of cash on hand just to stay flexible.
Okay, we've gone through a ton of data and a bunch of strategy. So what's the one big idea you should really walk away with from all this?
It's this. Look, trying to perfectly predict the future is a fool's game. It's just impossible. But understanding where you are in the economic cycle, using a framework like the investment clock, now that's a superpower. It's about having a strategy, not a crystal ball.
Which kind of brings it all back to you, doesn't it? We know where we are. We're in the overheat phase. We know the risks and the possible paths ahead. And we've got a strategy to deal with it, the barbell. So the real question is, knowing all that, how are you going to balance your barbell?